Gold is spiking, oil is surging. What's really going on? What if I told you the next global financial reset isn't coming from Wall Street, or from Silicon Valley, or even from Beijing? It's coming from a narrow strip of water in the Middle East. Right now, the world is watching missiles fly between Israel and Iran. But beneath the headlines and hashtags, there's a deeper war, one that's already rewriting the rules of money, energy, and power. In 1973, a tiny oil embargo quadrupled energy prices and brought the US to its knees. Today, over 20% of the world's flows through the Strait of Hormuz, and Iran just threatened to shut it down. If that happens, it's not just oil that spikes. It's inflation. It's gold. It's the US dollar. It's the price of everything. In moments like this, most people panic. But the wealthy don't panic. They reposition. They don't wait for the headlines. They read the undercurrents. And right now, those undercurrents are screaming that a global asset shift is already underway. This video isn't about fear. It's about understanding what's happening before the wave hits. So if you're holding cash, gold, stocks, or just trying to protect your savings, then listen closely. Because what's happening between Israel and Iran, it isn't just a war. It's a trigger, a financial one. Part 1. The global crisis behind the headlines. When you hear Israel versus Iran, your first instinct might be, that's a regional war. Maybe tragic, maybe volatile, but not something that's going to change your investment portfolio. That instinct could be very wrong. Because this conflict doesn't just involve rockets and rhetoric, it touches the three things that move the entire global economy: energy, currency, and trust. Let's begin with the geography. Iran controls access to the Strait of Hormuz, a narrow but critical waterway through which over 20% of all global oil exports pass daily. If this choke point is even partially disrupted, oil prices could skyrocket overnight, not just by a few dollars, but potentially into triple digits per barrel again. And when oil goes up, everything goes up. Fuel prices affect trucking, aviation, sand hipping. They push up the cost of food, construction, and consumer goods. Inflation doesn't creep, it erupts. Now add in timing. The global economy is already stretched thin. The Federal Reserve is trying to cool inflation without triggering a recession. China's growth is slowing. Europe is still reeling from energy shocks caused by the Ukraine conflict. And here comes another oil shock, possibly bigger, faster, and more globally disruptive than the last. This isn't just a war between two countries. It's a trigger point, one that could unravel fragile supply chains, reverse disinflation trends, and reignite a global financial storm. But it goes deeper. Why does the US dollar surge during times of crisis? Despite all the flaws, it remains the world's reserve currency. It's liquid. It's trusted. When nations need to buy oil, they do it in dollars. That means during times of panic, central banks don't just look at gold. They hoard USD to stabilize their exchange rates and keep imports flowing. Ironically, this boosts demand for US Treasury bonds, even when those same countries are frustrated with American policies. So now we have oil prices rising, inflation creeping back, and a sudden spike in the demand for dollars and US debt. What happens next? Let's look at gold. In normal times, gold is the go-to safe haven. But in this kind of liquidity panic, where everyone's scrambling to pay for higher energy costs and dollar-denominated imports, countries might be forced to sell gold, not buy it. It's happened before. In the early 1980s, gold prices tumbled even as global instability rose because nations needed dollars more than they needed bars of metal. And that leads us to the dangerous part of this triangle: volatility. In this triangle, oil, gold, dollar, when one corner spikes, the others often react violently. If oil rises too fast, central banks hike rates or buy dollars. If that kills growth, gold might rise again or crash if liquidity dries up. If the dollar gets too strong, emerging markets suffer, debt becomes unpayable, and capital flees to safety, back into US assets. That's how a Middle East conflict becomes a global chain reaction. Investors around the world, from Wall Street to Singapore, are already repositioning. You can see it in the charts. Oil ETFs are spiking. Gold is hovering near resistance. Treasury yields are yo-yoing. Currency markets are flashing stress signals, but the average person? They're just hearing headlines. Tensions rise. Leaders speak. Talks stall. By the time the evening news admits there's a financial crisis, the big money will have already moved. This is not fear-mongering. This is pattern recognition. Because if Iran does move to shut down or disrupt the Strait of Hormuz, even temporarily, it won't just hurt oil supplies. It will reshape how nations think about energy security, currency exposure, and investment strategy. That's the real crisis. A war you can see, a market realignment you don't. In the next section, we'll break down how you can position yourself ahead of this shift. Not with panic, not with hope, but with a strategy grounded in data, history, and economic logic. Because in this new world, being early isn't just profitable, it's necessary. Part 2, Survival Investing, how the smart money moves in crisis. When oil surges, gold trembles, and the dollar tightens its grip on global trade, you have two choices: panic or prepare. Smart investors always choose the second. They don't wait for certainty. They position early, not because they know the future, but because they recognize signals that others ignore. Right now, those signals are flashing red. And here's how the smart money is moving. 1. Energy first. Oil is the new currency. When a geopolitical conflict hits oil supply, energy stocks are the first to react. The market isn't waiting for war declarations. It's reacting to headlines, satellite images, and shipping disruptions. That's why funds like XLE, Dolly, and USO have already started to spike. Major oil companies like ExxonMobil, Chevron, CVX become frontline assets. They don't just sell fuel, they become geopolitical insurance. For more aggressive positioning, futures contracts on crude oil, WTI or Brent, allow high leverage plays, but only if you understand the risks. If oil hits $120 or beyond, these aren't just good trades. They're protective hedges. 2. The gold trap. Know when to exit. Gold is emotional. It moves not just on logic, but on fear, sentiment, and speculation. Right now, gold is hovering near resistance. Everyone's watching, but few are asking, what if central banks stop buying? Worse, what if they start selling? In a liquidity crunch, nations might offload gold to secure dollars. This happened in the early 80s and could happen again. If you're holding physical gold, now is not the time to blindly accumulate more. Instead, watch for technical signals. If GLD fails to break above its recent high, consider trimming your exposure. And remember, gold isn't a religion, it's a tool. Use it wisely. 3. King dollar, the safe haven nobody likes. The dollar might not be loved, but it's trusted. And that's what matters in a crisis. During oil shocks and market sell-offs, capital floods into US dollars and treasuries. That's why funds like UUP and long-duration bonds like TLT tend to spike during fear-driven cycles. But don't chase the dollar blindly. Watch for divergence between dollar strength and treasury yields. If yields drop while the dollar strengthens, it's a signal that global capital is seeking safety, not yield. And that's your entry point. If you're sitting on large cash reserves, consider parking some in short-term treasury ETFs. They provide yield while maintaining liquidity. 4. The defensive rotation. Who survives high oil? When oil rises, transportation suffers. Airlines, cruise lines, and trucking companies, their costs spike fast. This is where smart money goes contrarian. Instead of buying energy, they short the victims. ETFs like JETS, IYT, or specific stocks with poor fuel hedging can become high-risk short candidates. But there's also a safer rotation into consumer staples, healthcare, and utilities sectors that maintain demand even during downturns. If the oil shock extends into a full inflation wave, these sectors outperform not by growing, but by not shrinking. Number 5. Optionality. The real weapon of the rich. The wealthy don't just invest in assets, they invest in flexibility. That means keeping part of their portfolio in cash or liquid alternatives, ready to deploy fast when panic creates discounts. Think about this. If gold dips 20% because of forced selling, would you be ready to buy? If oil ETFs correct after an initial spike, could you re-enter with confidence? Optionality isn't laziness, it's a tactical edge. This is why many top-tier funds hold up to 20% in dry powder. Not because they fear risk, but because they want to control timing. 6. Stop predicting. Start positioning. Nobody knows if Iran will actually block the Strait of Hormuz. Nobody knows how far Israel will go. But we do know this. The global financial system is fragile. Energy prices are rising, and the smart money is already moving. That's enough. Instead of gambling on a headline, build a portfolio that survives headlines. Instead of guessing where gold goes, hedge what happens if it drops. This isn't a time for emotional investing. It's a time for strategic positioning. Final word. In every crisis, there's always someone who panics and someone who profits. The difference is never luck. It's preparation. In the next section, I'll show you how to set up a tactical playbook, including allocations, model portfolios, and when to move from defense to offense. Because when the oil smoke clears and the dollar dust settles, only those who moved early will be left standing. Part 3. The player behind the curtain, how the US quietly wins the crisis. When bombs drop in the Middle East, the world watches Israel and Iran. But behind the smoke and headlines, there's another player pulling strings, moving quietly and profiting steadily. The United States. And no, we're not talking about the government as much as we're talking about the American industrial elite, the energy giants, defense contractors, and financial institutions that quietly shape global outcomes. Let's break this down. The oil play, supply crisis becomes export jackpot. Over the past decade, the US has gone from energy dependent to energy dominant. It now produces more crude oil than any other country on Earth. Even Saudi Arabia. So when conflict threatens Middle East oil routes, it's not just about risk. For America, it's about opportunity. If the Strait of Hormuz is blocked, global oil supply tightens. And guess whose oil suddenly becomes more valuable? The US. With Europe still avoiding Russian oil and Asia scrambling for alternative suppliers, American exports can surge, and at premium prices. That's not a theory. It happened in 2022 when the Russia-Ukraine conflict pushed European buyers into US markets. Now, the same story is playing out, only bigger. Energy companies like ExxonMobil, Chevron, and ConocoPhillips aren't watching war. They're watching demand curves rise in their favor. The dollar trap. You need oil, oil needs dollars. Global oil is priced in US dollars. That's not accidental, it's geopolitical strategy. When oil prices spike, countries don't just need fuel, they need dollars to buy that fuel. That means rising demand for US currency and rising influence for the Fed. It's a cycle. Crisis, higher oil, higher dollar demand, stronger USD, cheaper US imports, deeper US control. And that's when the real power play begins. While other countries panic buy dollars to survive, the US can print them. Think about it. If Brazil needs oil, it must first convert its currency to USD. The US, on the other hand, simply issues debt or expands the money supply. This isn't just privilege, it's financial weaponization without firing a single shot. The defense industry, war becomes business. While oil funds the machine, the defense sector builds it. Every time conflict escalates, US defense contractors see their order books fill up. Not just from the US government, but from allies worldwide. Israel gets resupplied, NATO countries rearm, Gulf nations seek missile systems and drones. And guess who manufactures all of that? Lockheed Martin, Raytheon, Northrop Grumman, General Dynamics. The more unpredictable the world becomes, the more predictable their earnings. And while politicians speak of peace, these firms speak in quarterly profits, quietly underwriting the cost of chaos. The manufacturing mirage, higher global costs, lower US pain. Critics often say it's too expensive to build in America. But what if the US doesn't need to be cheaper, just less expensive than everyone else? If oil and transport prices soar globally, manufacturing in Vietnam, Taiwan, or Germany gets more expensive. Not because wages rise, but because everything else does. Raw materials, shipping, energy, insurance. That narrows the cost gap with US-based production. Add in subsidies, tax credits, and rising dollar strength, and suddenly, moving supply chains back to the US makes sense, not just politically, but financially. Capital migration. Follow the smart money. Money moves faster than armies, and it's moving toward the US. In times of crisis, global investors seek liquidity, stability, yield. Right now, America offers all three. Treasury yields are attractive, the dollar is strong, and the Fed, while cautious, still commands global attention. This means more than just money flowing into Wall Street. It means foreign capital buying US assets, real estate, equities, even farmland. In 2022, during peak chaos, global investment in US energy projects and industrial facilities hit record highs. That wasn't luck. It was positioning. The silent leverage when everyone else hurts more. Let's be clear, the US isn't immune to pain, but its leverage lies in this. When global crises hit, America hurts last, and often least. Europe suffers from energy dependency. Asia suffers a supply shock. The global South suffers currency collapse. The US, by contrast, becomes a magnet for safety, not because it's perfect, but because it's perceived as less dangerous than the alternatives. That's the ultimate power, not dominance through fear, but resilience through contrast. Final thought: who really wins the crisis? While the headlines focus on bombs and diplomacy, the back-end winners are rarely on TV. They're sitting in boardrooms, they're reallocating portfolios, they're making deals while the world argues. That's the real game. And in the next section, we'll lay out how you can play the same game at your scale by tracking where money flows, not just where cameras go. Because the real player behind the curtain doesn't need to speak. They already own the board. Part 4. What investors must do. 3 survival strategies for the crisis era. In times of war, ordinary people watch. In times of crisis, most freeze. But investors, real investors, they move. Not recklessly, not emotionally, but with purpose. And when oil rises, gold shakes, and the dollar flexes, you don't need 10 strategies. You need 3 core ones. Each is tested by history. Each is designed to protect, profit, and position. Let's walk through them. Strategy 1. Follow the fuel, energy first, everything later. Forget the headlines. Oil is not just fuel. In a crisis, oil is leverage. If the Strait of Hormuz is threatened, even partially, oil markets don't wait for facts. They price in fear. That's when smart money moves into XLE, the Energy Select Sector SPDR Fund. Exposure to U.S. energy giants. USO, the United States Oil Fund, tracks the daily price of WTI crude. ExxonMobil, vying CVX, safe, liquid, battle-tested. These are not speculative moonshots. These are volatility-adjusted plays. They act as both protection and profit. And if you're more experienced, futures on Brent crude or WTI can amplify gains and risks. But remember, oil spikes are violent. They don't climb, they jump. So don't chase green candles. Position before panic. Strategy 2. Don't worship gold. Traded gold is ancient. Gold is beautiful. Gold is misunderstood. Most investors assume gold always rises in war, but history says otherwise. During the Russia-Ukraine invasion in 2022, gold briefly surged, then lost ground. Why? Because as the dollar strengthens, gold softens. Right now, central banks are buying gold like never before. But that's not infinite. If liquidity tightens and countries need dollars, they may sell gold to survive. So here's how to handle it. If you're already holding gold, watch the resistance zones, e.g. 2,000 to 20,100 tarats. Use GLD or IAU to monitor ETF inflows and sentiment. Scale out if technicals show exhaustion. Don't diamond hand during liquidity stress. And always ask, is gold rising because of inflation or because of panic? Those are 2 different trades. Gold is not a savior, it's a signal. And signals are meant to be read, not worshipped. Strategy 3. Respect the dollar. Even when you disagree, you may not like the dollar, you may not trust the Fed, but in a crisis, others will rush to both. When oil rises, countries need dollars. When volatility rises, funds seek safety. When credit tightens, the global reflex is simple. Buy treasuries, hold dollars. That means UP Invesco's Dollar Bullish Fund rides short-term USD spikes. TLT, SY, or laddered bond ETFs for safe, yield-bearing storage. And don't forget, cash is also a position. Optionality is power. Holding cash now gives you speed later. When markets dip, you won't need to borrow. You'll already be armed. Putting it together, a crisis allocation blueprint. You don't need to bet everything on one idea. You need to build a barbell. One side, risk-managed exposure to oil and defense. Other side, defensive holdings in cash, bonds, and short-term yield. Center, a tactical gold position you can trim or add to on volatility. And across the whole portfolio, discipline. The kind of discipline that says, I'm not chasing headlines. I'll take profits when they appear. I'd rather miss 5% upside than take a 30% drawdown. This is not a game of ego. It's a game of longevity. Final thought. You don't need to predict. You need to prepare. Ask the richest people in the world how they got that way, and they rarely say, I predicted correctly. Instead, they say, I managed risk better. I kept cash when others didn't. I had a plan when others panicked. So don't try to guess if Israel or Iran will escalate. Don't wait for CNN to say it's a financial crisis. Don't rely on hope. Rely on strategy, because in a world where oil moves markets, gold shakes confidence, and the dollar drives destiny, only the prepared will come out stronger. Part 5. Risk and Portfolio Defense. Surviving the storm without sinking. Every investor loves to talk about upside. But professionals? They survive because they obsess about the downside. When war hits, oil spikes, and gold swings, it's easy to feel smart during the rally. The hard part is what comes after. Because markets don't move in straight lines, they breathe. They overreact. They punish the unprepared. So before you hit buy, ask yourself, what if I'm wrong? That question has saved more portfolios than any prediction ever made. 1. The oil trap. What goes up gets drilled down. Let's say you bet on oil and prices surge to $120. You celebrate. But 2 weeks later, peace talks emerge. Tankers resume. A key choke point reopens. Suddenly, WTI drops back to $85. If you overexposed or worse, bought at the peak, your position bleeds fast. Rule number 1, never chase parabolic moves. Rule number 2, always use trailing stops, especially in commodity ETFs like USO. Smart portfolios don't just buy the breakout. They scale in slowly and set exits before entry. 2. The gold whiplash. Fear is fleeting. Gold's biggest strength, emotional safety, is also its weakness. Once panic fades or liquidity tightens, gold can reverse violently. If central banks sell or if real interest rates spike, your precious metal may not feel so precious. How to defend. Never let gold exceed 10 to 15% of your portfolio unless you're in an inflationary collapse scenario. Use ETF hedging with options or counter trades. X, short, GDXJ miners on weakness. Have a re-entry plan in case of drop. Gold is cyclical, not linear. 3. Dollar exposure. Don't forget the swing. The dollar can protect you until it doesn't. If the Fed pivots, if yields fall too fast, if a debt ceiling standoff spooks confidence, the dollar's floor cracks. Remember, safe haven flows are trend sensitive. Once fear recedes, people re-risk fast, and USD can unwind sharply. Defense. Watch the DI index around key support zones. Hedge with small FX positions, X long USD, or rotate into real assets if the dollar weakens. Don't let UP or TLT dominate your core holdings. They're tools, not anchors. 4. Emotional allocation. Your biggest risk isn't the market. Markets go up and down, but portfolios fall apart when you fall apart. When you over-leverage, when you revenge trade losses, when you jump in and out based on Twitter, that's not a strategy. That's roulette. What protects you best isn't your asset choice. It's your behavior. So, build rules and stick to them. Max loss per position, 2 to 3% of total portfolio. Daily check-in time. Fixed window, no all-day staring, no new positions after 2 red trades in a row. Keep a panic checklist. Review it before touching the keyboard. Discipline isn't boring. It's what keeps your account alive long enough to grow. 5. Scenario-based thinking. Don't plan for one world. The biggest mistake investors make, they build portfolios assuming only one outcome. But great risk managers think in branches. Scenario A, oil spikes, gold rises, dollar strong. Scenario B, oil falls, gold crashes, Fed cuts. Scenario C, stalemate, sideways market, slow liquidity bleed. Build allocation layers that survive across outcomes. No strategy should win in one world and collapse in the others. Final thought. Survive first, then thrive. The market doesn't reward boldness. It rewards those still standing when the panic ends. And the panic always ends. So don't just ask, what's the best investment right now? Ask, how much pain can I take? How quickly can I adjust? What if everything swings the other way tomorrow? That's how professionals think. Because in this game, bold doesn't beat smart. Resilience does. If you've watched this far, you already know something most people don't. We're not just in a war zone, we're in a transition zone. From oil to gold to dollars, from fear to strategy, this crisis is more than a conflict between nations. It's a global stress test, a rebalancing, a power shift. Some people will freeze, others will chase headlines, but the smart few, they'll reposition early, quietly, intentionally. So here's the question you need to ask yourself right now. Am I building my future based on emotion or based on signals? If this video gave you clarity, even just one useful insight, then don't let it fade. Like the video so it stays saved in your playlist. Subscribe to the channel so you never miss the next shift. Share it with someone who still thinks this is just another war. Because by the time the news makes it obvious, it's already too late. This isn't about fear, it's about leverage. This isn't about prediction, it's about preparation. And in a world where timing is everything, early is the new rich.